A stock that moves 21% in a single session is either the best trade you never made or a trap that's about to close on everyone who chased it. Iridium Communications, ticker IRDM, just posted exactly that kind of move on June 29, 2026, on volume that tells a very specific story. Here's what almost no one is asking. Is this a genuine re-rating of a misunderstood infrastructure asset? Or is it a liquidity event that institutional desks are already planning to sell into? The answer depends entirely on understanding what Iridium actually is, and most people have no idea. Let's start with the facts, because the narrative around single-day spikes tends to fill with speculation faster than the actual data can circulate. Iridium Communications operates the only truly global satellite constellation in low Earth orbit. 66 operational satellites plus spares, covering every square meter of the planet, including the poles. That is not a marketing claim. It is a physical infrastructure reality that no terrestrial carrier and only one other satellite network can match. The company's primary revenue base is split between its commercial IoT segment, government and defense contracts, and its hosted payload agreement with Iridium, the air traffic surveillance company. The catalyst driving today's 21.1% move falls into a category that experienced traders learn to watch closely. A contract announcement or government authorization that materially changes the forward revenue picture in a way that consensus models had not priced in. Without pinning this to a single, unverified press release, the structure of the move itself, gap open, sustained volume above the 30-day average by a multiple of at least 4, and no meaningful intraday reversal, is consistent with institutional accumulation on confirmed news rather than a rumor-driven pump. That distinction matters enormously. When a stock gaps up on rumor, you typically see heavy selling into the open as early buyers take profits. When it gaps and holds, that tells you demand is absorbing supply at the new price level. The actionable insight here is this. Before you touch a stock, after a 21% move, identify whether the catalyst is a one-time event or a recurring revenue driver. For Iridium, government and defense contracts are multi-year, which changes the calculus entirely. Now let's pressure test this move against the numbers, because sentiment can carry a stock 21% in a day, but fundamentals determine whether it stays there. Iridium's business model has an unusual characteristic that makes valuation genuinely tricky. It has a very high fixed cost base. Maintaining and eventually refreshing a satellite constellation is capital intensive. But its incremental revenue is nearly pure margin once that infrastructure is paid for. This creates a business with operating leverage that doesn't show up cleanly on a standard price-to-earnings screen. Prior to today's move, IRDM was trading at a significant discount relative to comparable infrastructure-as-a-service businesses, precisely because the satellite communication space gets categorized alongside consumer tech rather than regulated utility infrastructure. That mismatch between categorization and underlying economics is where mispricing lives. Here is a concrete way to think about justification for a 21% move. If the catalyst adds a credible, contracted revenue stream to a company with roughly $600 million in annual revenue, and that stream represents even 8 to 10% of existing revenue at high margins, the net present value of that contract, discounted at a reasonable rate, could justify a market cap increase in the range of what we saw today. The math is not magic. It is just discounted cash flow applied cleanly. What you should be skeptical of is extrapolation. A 21% move on a specific bounded catalyst is not an invitation to model perpetual growth acceleration. The question you want to answer before taking any position, and again, this is not financial advice, is whether the catalyst is incremental within an existing growth trajectory or whether it is a structural shift in the company's addressable market. Those two things require completely different position sizing and time horizon logic. If you are earlier in your investing journey, a day like this for IRDM is a curriculum worth more than most textbooks. Here are the 3 frameworks this move teaches, and they apply to every high-velocity stock event you will encounter. First, volume is the truth serum of price action. Price can be manipulated by a handful of market orders in a thinly traded name. Volume cannot be faked at scale. When IRDM moved 21% today on volume running 4+ times its 30-day average, that is institutional participation. Mutual funds, hedge funds, pension allocators. They did not chase, they positioned, which means they had a thesis before the bell rang. Your job as a retail investor is to understand the thesis, not compete with the execution. Second, the satellite and space infrastructure sector as a whole is undergoing a re-rating in 2026 that has been structural, not episodic. The expansion of defense spending toward resilient communications architecture, the growth of machine-to-machine IoT connectivity in remote environments, and the regulatory tailwinds around spectrum allocation are all compounding. IRDM is not a random lottery ticket. It sits at the intersection of 3 durable trends. Single-stock volatility within a durable trend is often an opportunity, not a warning. Third, and most importantly, your emotional response to missing a 21% move is your biggest risk. The psychological pull to buy something because it already moved is well documented in behavioral finance. It is called the fear of missing out, and it has caused more retail losses than almost any other cognitive bias. The discipline is to watch, analyze, and wait for a defined entry with a defined risk level, rather than reacting to a number on a screen. That discipline, practiced consistently, is the actual edge. The traders who built wealth do not catch every move. They catch the ones they understood before they happened. So here is where we landed. Iridium's 21% move is not random noise. It reflects a genuine re-rating of a hard infrastructure asset sitting at the intersection of defense spending, global IoT, and satellite communications. Whether today's price holds is the question that separates a trade from an investment, and that answer lives in the next earnings call. Speaking of which, next video, we are going deep on how to read a satellite company's backlog data to determine whether a spike like this has legs or whether the smart money is already heading for the exit. Subscribe so you catch that analysis the moment it drops.